Good morning and welcome to this Monday, July 18th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're off to a decent start to a fresh week, even though historically this is not a good week. We are off to a pretty decent start. Was looking at futures just a few minutes ago. Actually, rather than go to futures, that's about gives me a 10-minute delay. Let me just pull up the Dow Jones and Spider and QQQ. Right now, the diamonds are up about 0.9%. So close to 1%. You're talking about 300 points on the Dow. So pretty good start. At least it looks like we're going to have a pretty good start today. The Spider is actually up, I think it was up just a little bit more on a percentage basis. Oh, actually just slightly less, about 0.8%. So the Spider doing pretty well this morning. And then the QQQ also up nicely this morning, although it was up more earlier, but the QQQ up almost 1% today, 2.9 or $295, pretty close to that level. So looks like we'll get off to a pretty good start today. Crude oil right now is up $2, close to $100 a barrel. It's been kind of in a $10 range for the most part. Let me pull that up 1 second and give you kind of the range there I was looking at. Yeah, right around 105 on the top. You've got recent price resistance, and I don't have this up on your chart yet. I'll pull this up in just a bit, but crude oil 105 price resistance. You've got the 20-day moving average at about 104, and then recent lows 93. We really don't want to lose $93 on the close if you're an energy bull, which I'm not. I think I had said back at the beginning of the year I thought energy could do well for a while this year. I just didn't think that it was something I would be willing to hold on to all year. And I think it's flipped. I think that energy and materials are not where you want to be right now. They have broken down technically, and I think money is rotating back into many of the aggressive areas of the market, and that's what I expected earlier this year. And I think we're starting to see that turn. I do think we're going to have a strong second half of the year in U.S. equities. All right, let me go through first. Well, I guess for those of you that are new to Earnings Beats, let me go ahead and show you where you can find us. So if you go over to EarningsBeats, excuse me, if you go over to EarningsBeats.com and scroll down, there will be an opportunity to join our EarningsBeats Digest. Got a form there. All it takes is name, email address, no credit card required. You can unsubscribe at any time. Just type in your name, email, hit that subscribe button, and we'll get you set up. Comes out 3 times a week, Mondays, Wednesdays, Fridays, normally out about an hour before the market opens. So we should be in pretty good shape there, getting you ready for the market day. Sometimes it's a good trading opportunity. Other times it's just an educational feature, something that, looks interesting to me. But it's a very quick read, normally just a couple paragraphs in a chart. So make sure you go over to earningsbeats.com, sign up. Also, by being a member of our community and our free Earnings Beats Digest, we invite you to our free events. And we have one of those coming up tonight. And that is our Q2 earnings sneak preview. I think this is one of the most important, if you're a trader and you just go into earnings haphazardly, I think you're going to find that you're going to get some right, you're going to get some wrong, and it's just going to be very frustrating. I think that you can give yourself a little bit better odds than 50-50. And that is by looking at relative strength. And that's what we're going to do tonight. Go through a number of earnings reports, upcoming earnings reports. I'll give you some of the earnings reports that I think should come out pretty strong. Others I'd be a little bit more cautious about as we head into earnings season. One company that I believe we had on the Earnings Beats Digest, maybe I think it was 2 weeks ago, was United Health Group, and talked about the fact that the company had beaten Wall Street estimates 58 consecutive quarters. So it's got a pretty good history of beating estimates. Well, they beat again when they reported last Friday, and the stock was up really nicely. And that was one of those, it's kind of a sneak preview of the sneak preview, if you will. Talked about the fact that I thought UNH would have a good report that they'd beat, and it might be an opportunity to see the stock run up into earnings. It ran up, pulled back a little bit right before earnings, and then when the earnings came out, actually exploded back up to the upside. So really good reaction and a solid report as well. UNH not only beat on the top and bottom line by a wide margin, but also raised guidance for the rest of this fiscal year. So really strong report there. All right, let's move on to, actually, I don't know if I didn't set this up just yet. Running a little late this morning. I was actually out of town this weekend, played in the golf tournament. So things a little slower for me this morning, you probably can tell. But here are the areas things I want to talk about. If you're new to the show, first of all, welcome. But I always like to go through the major indices, or at least what I consider to be the major indices, the ones I really like to follow, which is the Dow, S&P, NASDAQ, the S&P 400 mid cap, and the S&P 600 small cap. So it's given us a number of different asset classes there. And I think for me anyway, the one that I focus on the most is right there in the middle of the NASDAQ, just because that's going to be home of more of the aggressive stocks, the growth stocks. And so that's one I like to compare relative to these other indices. When the NASDAQ's performing well, and even when the small caps, I like to see the small caps doing well, and they've been struggling a little bit of late. But when you get those two going, that's a pretty good sign that the market has an appetite for risk. And when the market has an appetite for risk, you really don't want to be shorting. You want to be on the long side. I think your opportunities are a lot greater there. Your odds are a lot greater. And so that's kind of my approach. On Friday, we saw the Dow Jones Industrial Average up 658 points. S&P was up 73. NASDAQ up 201. On a relative basis, actually, the Dow was the better performer there. Mid caps went up almost 2%. Small caps were up a little more than 2%. It was just a solid all around kind of day. And look at the AD lines. First of all, look where price action is. We've been going down all year. We're not even, as far as I'm concerned, the downtrend hasn't broken. We haven't gotten that confirmation yet, even though I do think we bottomed. And that's because of rotation. But we're well off the highs from earlier this year. Look at the Dow's AD line. That was a new high on Friday. S&P, new high on Friday. NASDAQ approaching a new high on Friday. Mid caps, small caps, new highs. It just does not smell like a bear market right now. I'm sorry. I'm just looking at these charts. I'm not, I think maybe 6 months ago, some of you probably thought, well, he's just a perma bull. I hope after the first 6 months of this year, you realize I'm not a perma bull. It's just that the market goes up a lot more than it goes down. So yes, I am going to be bullish most of the time. But when a cyclical bear market comes along and the signals are beating me over the head, I'm not going to be a perma bull. And I think that hopefully has come through loud and clear here in 2022. But I do believe we bottomed. You can go on YouTube, search. I think the name of that video was "I'm Calling a Bottom." So search my name and "I'm Calling a Bottom" on YouTube and go back and watch it. But I think it was on Tuesday or Wednesday of option expiration week in June. So it's probably like the 14th or 15th. And I basically was saying, and what I've been, what I was talking about that week was, we had the Fed meeting on Wednesday. We had options expiring on Friday. I said, whatever the low was that week, I thought would be the bottom. And so far, that's turned out to be true. Moving on to the sectors, financial, very strong on Friday. And this is on the heels of banks not exactly reporting great numbers. Bank of America came out this morning. They missed, and they're up in pre-market action. You might look at it and say, well, this doesn't make any sense. These banks they're losing money. Or they're missing estimates, not necessarily losing money, but missing estimates, and they're going up. Look at JP Morgan. They came out on Thursday morning with their earnings. They were not good. The stock went down to a new low. And then on Friday, they came back up higher than where they were going into their Thursday earnings report. It's the market's already built in a lot of bad stuff. And that's something that's, I think, hard for a lot of folks to grasp that don't follow technical analysis. If you follow technical analysis and look at the price action, you'll notice over the years, the price action, if we're going to have some bad news coming out, the market doesn't wait for the bad news to come out. The market's pretty smart. Wall Street, those big Wall Street firms, they're brilliant. They got a lot of really smart folks working for them. They see that stuff. They know it's coming ahead of time. You got to see the price action. You can't wait for the news. The problem is, look what happened last week with inflation. Horrible inflation. I mean, the CPI, when it came out, the headline number was higher than expected. The core number was higher than expected. And I think that was Tuesday. I think on Wednesday, we got PPI out. Headline number worse than expected. The only silver lining on either of those inflation reports is that I think it was the core PPI that came in just slightly better than expected. But otherwise, the numbers were bad. The headlines were bad. The media was all over it last week. And I don't know if you saw it. Anyway, the sectors here, all 11 were higher. I'm going to go ahead and move on to the 10-year Treasury yield because I want to show you the reaction last week to this horrible inflation news. This is where we ended the week prior. This is what we did in the 10-year Treasury yield last week. We were coming down 5 days, all 5 days, basically. We finished lower on the 10-year Treasury yield. That means people were buying the 10-year Treasury yield last week. Now, this isn't rocket science. If you're holding a 10-year Treasury that's paying you 3%, are you really worried about inflation? Right now, core CPI is at 6%. If you think inflation is a runaway, it's already at 6%. You think it's going higher. Why in the heck would you buy a bond that yields 3%? You're losing 3%. The market is not worried about inflation. That's what this story is telling me. Maybe it was for a while, but I think the market has come to the realization that the Fed has finally decided that they're going to fight inflation. Forget about the economy. They don't care about whether we have a recession. They're picking their battle. Their battle is inflation, and they're going to make sure inflation's not a problem. And if you look at the way the bond market's trading and you look at the way the stock market's trading, Wall Street believes inflation's not a problem. Forget about the stories. Forget about the news you just saw last week. Wall Street is saying we don't care. And if Wall Street doesn't care, I don't care. I look at the charts. I look at the intermarket relationships. I look at how the money is trading. I don't care how the lips are moving on CNBC. I want to know how the money is trading on Wall Street. Just give me the charts. I'll look at a million charts before I'll look at one CNBC article. I think that's the better way to do it personally, but I don't, the thing is sometimes I'll get into conversations and I really am not up on current events sometimes because I don't watch news. I don't read, I don't go through the media. And so some folks come up to me, do you see about that, train wreck or this fire or this thing happened? I'm like, actually, I haven't. I didn't see it. Mostly because I like to tune out everything. Anyhow, 10-year Treasury yield. Yes, it's been an uptrend. Watch that 270 level to the downside. If we lose 270 to the downside, I think bond market is really starting to begin to price in the Fed becoming more dovish in the second half of the year. And I believe that's going to happen. I think we're going to get a rate hike this month. I think it's becoming a little bit more blurry. I don't think the picture is that clear, but I do think they'll raise one more time. And I think they're done. I do not think we'll get another rate hike after this one. Maybe I'm wrong. We'll see. And if I am, I'll say I was wrong. But that's what I believe. I think that's what the bond market's starting to tell me. We were at 348. Got horrible inflation in June, just got horrible inflation numbers in July. And we've gone from 348 down to 298. We were down in the 270s. Just doesn't add up. All right, move on to the S&P 500 here. So this is what I was talking about. We're in a downtrend. I don't think you can call this anything other than the downtrend. If you just look at the price action, you don't pay any attention to intermarket relationships, and you're just looking at the chart. And this is what a lot of technicians have a problem with. You know, a lot of folks who just don't pay any attention to technicals look at the news and don't understand why the market does one thing while the news is doing something else. Well, that's why the market's already priced in the news. So when you start getting the news, you're getting programmed to be really bearish. You think this is the end of the world. It's not. It's not the end of the world. We had a market that had gone up too far, too fast. And it just needed a pullback. Now, what confuses, in my opinion, a lot of technicians is you see the downtrend. You look at the PPO, it's still negative. Just about anything you look at doesn't look very good. You know, lines are pointing in the wrong direction. Moving averages are going down. This is not good. You know, we're still trading below the 50-day moving average. We can't possibly have bottomed. Well, I can promise you that every bottom forms below the 50-day moving average. That's the way it works. So it doesn't matter which one you're looking. It's not like you can climb above the 50-day and then mark a bottom. That doesn't happen. You mark the bottom before you get above the 50-day. I think you have to look at intermarket relationships to begin to see where money is rotating. Wall Street will tell you, well, let me say this. Wall Street will not tell you with their lips on CNBC what's going on and what they're doing. They will tell you if you look at the charts, though. So right now we got the S&P 500, you know, in a downtrend. I mean, I don't care how you draw the lines. Let's annotate this. I mean, I can't curve these lines. This is clearly a downtrend. I mean, I don't know if we want to start here and go, you know, along these tops. Then we could drag that line over here. See if you can connect it somewhere. It's probably like maybe right in there. And we can kind of extend this down. But that's a channel. That's in a downtrend. Or get rid of that. I don't know, maybe go all the way over here to the December low if you want. Call that the downtrend line, connecting all these lows. Trend lines are pretty subjective. You know, you could say, okay, that's the range we're in, or that's the channel. But no matter how I draw these lines, I can't turn this into an uptrend. We're downtrending. But let me come out of here. Let's do something a little different here. Now on the under the S&P 500, first thing I'll do is I'll just add QQQ in the spider. Now we're going to look at intermarket. And we'll pull up. These are just a couple of my favorites I like to look at. XLY, XLP. And we'll do one more. Just something to give us growth versus value. So I like IWF, IWD. Just two ETFs. One tracks, IWF tracks growth. IWD tracks value. It's at the large cap level. And let's go ahead and pull these up. Let's take a look at what's going on. Now let's make this a little bigger. All right. So here's your S&P 500 chart going down. QQQ, well, shoot, we're still going down. XLY, XLP still going down. IWF, IWD is going down. What are we talking about? What's this do? Well, I want you to look at a couple of things here. Let's annotate this one. And here, I want you to look at the low that we established right here on the S&P, and then the low that we established that week of June where I said I was calling the bottom. Now, from the beginning of the year to that first vertical blue dotted line, S&P setting new lows, and so is the QQQ versus the spider. So is the XLY, XLP, they're all going down. So is the IWF, IWD. But when we set this next low on the S&P 500, way below the prior low, Look at the relative. Look at what's taking place over here. NASDAQ's outperforming the S&P 500. Now, I don't want you to look at this as just a line on the chart. I think part of the problem with a lot of technicians is they're just looking at lines on the chart and they're not thinking about common sense. To me, some of this intermarket relationship work is just common sense. And by the way, I give total credit to John Murphy. That's where I picked up intermarket relationships and analysis. And it's really inspired me just to do a lot of work, go back and study history. And one of the things that you do have to pay attention to is many of these growth versus value, aggressive versus defensive. These types of relationships are really important in determining whether or not a move is sustainable. So is this downtrend sustainable? Throughout the year, I've been writing articles over at Stock Charts for those of you that are not members of EarningsBeats. Anybody who's been a member of EarningsBeats knows throughout the year, I've been pretty bearish. I give you daily market reports every day. At Stock Charts, I write every once in a while. So those of you maybe have been following me at Stock Charts, you go back and you look at all my charts, many of them, these bounces, I could tell you, go back and write or read my articles. I can promise you, I was not saying the market that the bottom was in. Many of these cases, and this was probably one time where it was like, okay, wait a minute, we're taking out that double top. So maybe right there, but even that one, I think once we started to roll back over, it was like, okay, we're not done yet. We're going back down. But I stayed pretty bearish throughout the year. Even when we got into rallies, it was like, okay, this is nice. But we did an anatomy of a cyclical bear market or cyclical bear market back in February. I think it was February 10th or something like that. And so I was letting our members know what these cyclical bear markets look like. You know, just because you got this big pop or this pop over here, those are normal. You can get 8, 10, 12% moves. They're counter trend moves back to the upside. And they're the worst ones to buy into. Why? Because usually right after is another big swoosh and another new low. Right here was a really big move. But look at this. April was the worst time to be in the market. April was horrible this year. Into May, then we got this move up. And then look at this, another big swoosh. You don't want to be buying into counter trend rallies. But on this low, and there was the way that the QQQs traded was also amazing. I won't get into that. We don't really have time. But this move down here, going into a new low, if you're just looking on the surface and you're looking at the S&P 500, what the heck has changed? Nothing, right? You're just bouncing and it fails and you go to a new low. And that's what I, read from just about every technician and most technicians that I have tremendous respect for. It's just they're looking only at the price action. Yeah, we set a new low. I can't argue. That's fact. But it wasn't the same. The QQQ versus Spider didn't break down. It went down with every one of these lows. Not this one. And right now, we're sitting at about a, 2.5 month high on the relative, the relative action there. XLY, XLP came close to going to a new low a little bit later in June, but we're starting to bounce back. We still haven't set that new low. That one was, if I said, maybe a week or so ago, if there was one thing that's kind of keeping me up at night about my bottom call, it's this ratio right here, because this is a big one for me. I think discretionary needs to outperform staples for me to feel good about a bottom being in and a rally being sustainable back to the upside. And this you can see is kind of teetering. Here we went up to a high over this high. This one didn't. So this is one I'm kind of really watching closely. I'd like to see this one start to turn back up again. And then the last one, growth versus value. Look at what's going on. All new lows, January, March, into May. All these price lows on the S&P being matched by relative price lows. In other words, money is rotating out of growth even faster on the way down. But in June, money rotated into growth. Why in the heck would that happen? Well, it's the same reason I called the top. back at the end of the year. S&P going up, up, up. The last high right here. Look at what the ratios did. Ratios up, up, up. Last high, whoops, going down. Last high, whoops, going down. Last high right here in January, oops, we're going down. We were going up, up, up with these ratios. The last high, they were all going down. Wall Street was moving out of growth. How many of you, I wish I could see your hands. How many of you heard Wall Street parading on the CNBC calling a top? Well, back at the end of December. I'm sure there weren't any. Except the usual suspects. You always have some folks that are just perma bearish. They're always bearish. And then every 10 years when the market goes down, they can say they were a genius. Let's not worry about the other 9 years. What is it? I think it's Jeremy Grantham. He's a smart guy, but he's a pessimist. I mean, you know, he's saying that this is it. This is the collapse. But a year or 2 years or 3 years ago, he was saying the same thing. The market had to go down 25% to get back to where it was when he first started making these claims. And Peter Schiff, don't even get me started on that guy. He's got to be the, I don't know. I'll be nice. I won't say anything. I'll just leave it at that. He's very bearish all the time. And then likes to point out, and CNBC likes to point out that he always calls the tops. Of course he does. If you call top every year, you're going to get it right every once in a while. Anyway, when I look at this chart, I just see positive action. I see money rotating. Why is money rotating into growth since the May? You know, why in June we were going to new lows? Why was money rotating into growth and to more aggressive areas of the market? These are questions. These are things you have to look at on the charts and ignore what you're hearing. Prices tell us so much more. Anyway, banks. Talked a little bit about banks. So look at what the bank index did on Friday. I mean, we had reports last week from some of the big banks. I didn't see anything that looked that great to me, but it's built in. We were at 640 on the bank index beginning of the year. We went down under 420. What do we want to, I mean, do we need to go to 300? Do you want to go down to 100? I don't know. If it does, trust me, we're going to have a lot of problems in this world, and it isn't just going to be the bank chart. We've already gone down a third. It's built in. Yeah, we're going to have a recession. We're in it. Talked about it earlier this year. Doesn't matter. It's built in. Prices going lower. Look at the PPO turning up. Positive divergence. Going down, down, down. AD line near about a 4-month high. Guess what? While everybody's talking about on CNBC, the market being horrible, inflation soaring, recession coming, all these things. While everyone's selling, guess who's buying? All the institutions, Wall Street. They might as well just, you know, go on CNBC and thank everyone. Stinks the way the market works. Stinks. But it's the way it works. All right, it's almost 9:30. I'll just say this, you know, we got some housing reports coming out this week. There's really not much coming out in the way of economic news. Inflation reports are now behind us. We do have the Fed coming up a little bit later this month. It's not this week, it's next. So we'll get into some of the Fed talk. Probably, I mean, I know this week historically is not a good week, but I'm really not bearish. Personally, I'm out of leveraged ETFs because I like to play the QLD when the market's coming back and the NASDAQ's leading. I think the QLD is a good play. I don't play it very often during the year, but when I get in situations like this, I think it's a great reward to risk play. I believe the market's bottom, so why wouldn't I want to get in? So I've been trading those, but as of this morning, I have zero. I have no leveraged ETFs. And that's because of the respect I have for the historical trends. If it weren't for that, I'd swear this market goes up this week. And I think it probably will. But that this week is the second worst week of the year historically for the S&P 500. The only worst week is October 21st to October 27th. That's dating back to 1950. That's looking at all the data since 1950. This is the second worst week. And I think the reason is the market normally goes up into earnings season. When earnings season kicks off, usually the 3 weeks leading up to earnings season are 3 of the best weeks you're going to get. For all 4 quarters, market usually anticipates good earnings and goes higher. Once the earnings start to come out and you've got options expiring, that's normally when we go back down. This year could be different because we haven't really had a huge rally. I mean, if we look at the S&P 500, yeah, we've come up off the bottom, but I wouldn't exactly say we've been flying. So maybe this is the year that we go higher this week. I mean, it's certainly a possibility. Let me just tell you real quick before we wrap this up. I'll go, let's look at earnings that came out this morning, and we'll pull those charts up. This will be the 3 you must see. First off, let's look at Bank of America. Look at the chart. Look at this move up here, up 3% today on Bank of America, moving to the highest level we've seen maybe in the last 5 weeks. They missed their earnings this morning. They were expected to earn 77 cents. They earned 73, and the stock gap's up 3%. I don't know. That doesn't make a whole lot of sense to me. But it is what it is. And you're going lower here, higher PPO, positive divergence. Let's see what happens when we get to the 50-day moving average. That's going to be important. Next up, PLD, Prologis, gapping up above the 50-day moving average. They missed their earnings this morning, 111 versus 112. So here we got 2 of them now that have missed earnings and gapping up. That's another big one that reported was Goldman Sachs. They actually beat 773 versus 699, and they gapped up above their 50-day moving average. So I gave you 2 that didn't report, that missed earnings, and 1 that beat, and all 3 went up. And I think that's kind of where we are in the market right now. These stocks have been sold off hard. I think if you have a good report, you're going to get rewarded. And if you have a bad report, everybody's going to think, well, it's probably the worst is in. And I said a month ago, I thought we were now into a market where good news is good news for the market and bad news is good news for the market. Whereas first 6 months of this year, it's been the opposite. Didn't really matter. The market was going down and companies would have good reports. They'd still go down and, you throw your arms up in the air. Like, what the heck's, we had a great report. Doesn't matter. Market's looking ahead and didn't like what it was seeing. That's why we were going down. Now the market's looking ahead and it's starting to like what it sees ahead. That's why prices are going up, not because of today's news. Anyway, that's all I have for today. Let's get a quick update of the market and then we'll wrap it up. Got the Dow Jones up 321, S&P up 37, NASDAQ up 146, NASDAQ leading on a percentage basis today. So that's nice. Over here looking at percentage down, ignore that. Google had a 20-for-1 split. Trust me, they didn't lose $2,000 overnight. They had a 20-for-1 split. So once the price action is adjusted over at stock charts, that will be removed. Anyhow, that's all I have for today. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV. So at 9 o'clock tomorrow morning, just click on that and come join me for the next episode of Trading Places Live. Have a great day, everybody. And don't forget, we have a big a sneak preview of earnings coming out later today. All you have to do is be on the EarningsBeats newsletter. Go down, subscribe, and then we'll send you room instructions. You can come join us for this sneak preview event later today. Have a great day, everybody. Happy trading.